You know that feeling when you log into your banking app, stare at your savings for a minute, and then just sigh? It's like you are working hard, you are doing everything the gurus tell you to do, but the number on that screen just is not moving fast enough to match the rising cost of, well, everything. You see the price of milk going up, you hear your friends talking about how much rent they are paying, and suddenly, that cash in your account does not feel like security. It feels like a melting ice cube. And then the anxiety kicks in. You start scrolling through social media or watching the news, and it's just this constant noise. One guy is screaming that the economy is about to collapse and you need to buy gold bars and bury them in your backyard. Another guy is wearing a blazer that is too shiny, telling you that the only path to freedom is leveraging everything you own to buy a duplex in a neighborhood you have never visited. It's overwhelming. Honestly, it's paralyzing. You end up doing nothing because you are terrified of doing the wrong thing. You are stuck between the shiny metal and the brick house, and nobody is giving you the real numbers. They're just giving you the hype. My name is Jack, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth, while others stay stuck in the same financial patterns for decades. I've been down this rabbit hole, man. I have spent sleepless nights staring at spreadsheets, looking at 50 years of data, trying to figure out what actually works when you strip away the emotion. Because here is the thing. This is not just about math. If it were just math, we would all be rich. It is about psychology, it is about fear, and it is about understanding the rules of the game before you sit down at the table. And today, we are going to settle this. We are going to look at gold versus real estate, not with opinions, but with a strategy that might just flip your entire worldview on wealth upside down. So grab a drink, get comfortable, and let us dive into the numbers. Because by the end of this, you are not just going to know which asset class wins on paper. You're going to know which one fits your life. Let us start with the basics, but let us not be boring about it. When we talk about gold and real estate, we are talking about two totally different animals. They sleep in different beds, they eat different food, and they behave differently when the weather turns bad. Gold is the drama queen of the financial world. It is the fear trade. People do not buy gold because they are excited about the future. They buy gold because they are terrified of it. When inflation spikes, when wars break out, or when governments start printing money like it is going out of style, gold is the lifeboat everyone rushes to. It does not do anything. It does not pay you a dividend, it does not innovate, and you cannot live inside it. It just sits there glowing, saying, "I told you so." It is a store of value. It is supposed to be the thing that keeps you from going broke when the world goes crazy. Real estate, on the other hand, is the workhorse. It is the asset that sweats. Real estate is about utility. People need a place to sleep. Factories need a place to build things. Stores need a place to sell stuff. It is tangible. You can touch it, you can improve it, and if you own it, you have a lot of control over it. But it is messy. Toilets break, tenants ghost you, and sometimes the market crashes and leaves you underwater on a mortgage you can barely afford. So, you have got the shiny, inactive metal that loves chaos, and you have got the heavy, messy, productive asset that loves growth. The question is not which one is better in a vacuum. The question is, how do they perform over the long haul when you apply real math? I want to take you back to a specific moment in time. Let us go to the 1970s. It is a wild time. Disco is booming, gas lines are around the block, and inflation is absolutely out of control. If you had $10,000 in 1970 and you decided to buy gold, you would have paid about $35 an ounce. So you would have roughly 285 ounces of gold. Fast forward to today, gold is trading. Well, prices fluctuate, but let us say it is hovering around that $2,000 mark. Your $10,000 just turned into over $500,000. That sounds incredible, right? You made a 50 times return just by sitting on your couch. That is the story gold bugs love to tell. Buy it and forget it. But wait. What if you took that same $10,000 in 1970 and put a down payment on a rental property? Let us say you bought a modest family home in a decent suburb for, I do not know, $25,000. You put $10,000 down and took a mortgage for the rest. Over the last 50 years, that home probably appreciated in value. Maybe it is worth $400,000 or $500,000 today. On pure price appreciation, gold probably beat the house. If you just look at the price tag, gold wins. But, and this is a huge but, that is lazy math. That is the math people use to sell you newsletters. It ignores the mechanism of wealth. This is where the conversation changes. This is where the real math strategy actually comes into play. Because in the real world, most of us do not have $10,000 to just throw at a gold bar and forget about for 50 years. But even if we did, real estate offers something gold never will, and that is leverage. Leverage is just a fancy word for using other people's money to get rich. When you buy gold, you have to pay 100% of the price. If you want $10,000 of gold, you need $10,000 cash. Simple. But when you buy real estate, the bank lets you play with their money. You put $10,000 down, but you get to control a $100,000 asset or a $50,000 asset back in the 70s. This changes your return on investment exponentially. Let us look at that scenario again. You put $10,000 into gold. The price goes up 5%. You made 5% on your money. You put $10,000 into a $100,000 house. The house goes up 5%. The house is now worth $105,000. But you only put in $10,000. So, you made $5,000 in profit on a $10,000 investment. That is not a 5% return. That is a 50% return. Do you see the difference? It is the difference between riding a bicycle and flying a jet. Real estate allows you to amplify your gains because you are controlling a much larger asset base than your actual cash outlay. Gold cannot do that. If you try to borrow money to buy gold, the interest rates usually eat you alive because it is a speculative asset. Banks love real estate because they know if you stop paying, they can take the house. They do not want your gold bars. They want bricks. This leverage effect compounds over time. It is the single biggest reason why real estate has created more millionaires than any other asset class in history. It is not because houses are magical. It is because you get to control the equity of a massive asset with a small amount of cash. Okay, so leverage is great on paper. But let us talk about survival. Let us talk about paying your bills. This is where the gold argument really starts to fall apart for me. If you own $500,000 worth of gold today, what does it do for you? It shines. It looks good in a safe. That is it. You cannot eat gold. You cannot pay your electric bill with a flake of gold. To get money from gold, you have to sell a piece of it. You have to chisel off your wealth, little by little, to survive. Every time you sell a coin, your pile gets smaller. It is a dwindling resource. Now, let us look at that $500,000 property. Assuming you have paid down the mortgage over those decades, or even if you have not, that property generates rent. It kicks off cash every single month like a clockwork orange. That money goes into your pocket. You can use that money to live, to reinvest, or to buy more gold if you want. This is what I call sleeping money. With real estate, your money works while you sleep. The tenant pays your mortgage, they pay your taxes, and they give you extra profit on top. Your asset actually feeds you, rather than you having to feed it. I had a friend, let us call him Dave. Dave is a classic gold guy. He has got this bunker mentality. In 2008, when the market crashed, Dave was laughing. He called me up, ecstatic, because his gold went up while my property values dropped. He felt vindicated. But here is the part he did not tell me. Dave lost his job in that recession too. And because all his money was tied up in shiny metal that was not generating cash flow, he had to sell his gold to buy groceries. He sold at the top, sure, but he was selling his life raft. Meanwhile, my rental properties? Yeah, the value dipped on paper. But the renters kept paying rent. The cash flow did not stop. In fact, because interest rates dropped, I was able to refinance and lower my payments, increasing my cash flow. I was not just surviving. I was thriving. I was buying more property while people were panic selling. That is the difference. Gold is a hedge against disaster, but real estate is a business that survives disaster. We need to talk about the things that steal your money when you are not looking. Everyone knows about inflation. Money loses value over time. But what people forget is that different assets react to inflation differently. Gold is actually pretty good at fighting inflation. Historically, it holds its purchasing power. If a loaf of bread costs $1 more, an ounce of gold is generally worth $1 more. It tracks the cost of living. That is its superpower. Real estate fights inflation too, but it does it with a twist I absolutely love. When inflation goes up, usually the value of the property goes up, and so does the rent you can charge. Your asset grows with inflation. But here is the kicker. Your mortgage payment is fixed, assuming you have a fixed-rate mortgage. If you locked in a 30-year mortgage at 4% 30 years ago, You are paying that mortgage with dollars that are worth significantly less today. It is like the bank gave you a loan in 1990 dollars, and you are paying them back in 2024 dollars. The bank is losing and you are winning. Inflation actually erodes the debt you owe on the property. With gold, you do not have debt. You have cash. Inflation eats the value of your cash, but your gold just floats alongside it. Real estate uses inflation as a weapon to destroy your debt. It is a subtle but massive difference. And then there is the tax man. Oh, the tax man. This is the part where everyone's eyes glaze over. But listen, this is where you win or lose the war. When you sell gold at a profit, the IRS treats that as a collectible or a capital gain. You pay tax on that profit. Period. There are very few tricks to avoid it. Real estate, though? Real estate is the playground of the wealthy because of the tax code. We have things like depreciation. Basically, the government assumes your house is falling apart and losing value over time, even though it is actually gaining value. So, they let you write off that loss on your taxes against the income you make from rent. This can mean you make $10,000 in real profit on paper, but for tax purposes, it looks like you broke even or lost money. So you pay zero taxes. You can also do a 1031 exchange, where you sell one property and buy another, deferring the taxes forever. Or you can hold the property forever, pass it to your heirs with a step-up in basis, and those capital gains taxes, poof, vanish. Gold has no depreciation. Gold has no 1031 exchange. You buy, you hold, you sell, you give the government a cut. Real estate allows you to keep more of what you earn. It is not just about what you make. It is about what you keep. All right, I have been beating up on gold for a while. I need to be fair here. I need to take off my real estate hat and put on my I hate dealing with contractors hat. Because we have to talk about the headache factor. Gold is easy. Stupidly easy. You buy it, you put it in a safe, or you pay a small fee to store it in a vault. That is it. It does not call you on a Saturday night to tell you the toilet is overflowing. It does not need a new roof. It does not care if the roof leaks. It requires zero maintenance. It is the ultimate low-maintenance relationship. Real estate is a high-maintenance partner. It needs constant attention. If you own physical property, you are a business owner. You are a landlord. And if you have never been a landlord, let me tell you, it is not for the faint of heart. There is the 3 T's: tenants, toilets, and trash. Tenants can be amazing people who treat your house like a palace. Or they can be nightmares who stop paying rent, destroy the walls, and then vanish into the night. Evicting someone is a painful, legal, drawn-out process that feels like it lasts an eternity. I have had tenants who I thought were friends turn into completely different people the second the rent check was late. And then there is the maintenance. Water heaters die at the worst possible time. Roofs leak during storms. Trees fall on fences. It seems like every time I build up a nice emergency fund for a property, something breaks that costs exactly that amount. It is a law of the universe. And you cannot just ignore it. If you ignore a problem in a rental property, it does not go away. It gets 10 times more expensive. A small leak turns into mold. A loose shingle turns into a ruined ceiling. So when we do the math, we have to factor in these costs. We have to factor in the property management fees. If you are smart enough to hire someone else to deal with the tenants, the vacancy rates, the months when nobody lives there, and you pay the mortgage out of pocket, the insurance, the taxes, and the repairs. When you strip all that away, the return on real estate is not as astronomical as the gross numbers look. But here is the irony. Despite all these headaches, despite the leaking toilets and the late-night calls, real estate still wins the math game for most people. The cash flow and the appreciation are just too strong to be killed by a broken water heater. But you have to have the stomach for it. If you value peace of mind above all else, gold starts to look very attractive. There is another angle to this that we do not talk about enough. Speed. How fast can you get your hands on your money? Gold is liquid. I mean, it is not like cash in your pocket, but you can sell gold coins or ETFs almost instantly. Click a button and it is sold. You have your cash in a couple of days. It is there for emergencies. If you get sick or lose your job, your gold is a lifeline you can grab immediately. Real estate is the opposite of liquid. It is like trying to turn an aircraft carrier around in a bathtub. You cannot sell a house quickly. It takes months to list a property, find a buyer, do inspections, and close the deal. And if you need money now, like right this second, you are out of luck. You might have to sell at a massive discount just to get cash fast, which destroys your wealth. I remember a guy I knew who had a ton of equity in his properties, but zero cash. He had a medical emergency, and he could not pay the bills. He was paper rich but cash poor. He eventually lost a property to foreclosure because he could not float the payments during a rough patch, even though he had hundreds of thousands of dollars in equity. It was tragic. If he had owned some gold, he could have sold a bit and survived the storm. So, the strategy here is not picking one and ignoring the other. The smart money realizes they play different positions on the field. Let us get inside your head for a minute. Because investing is 80% psychology and only 20% math. When you own gold, you are constantly watching the chart. It is volatile. It swings up and down. When it drops 10% in a week, you feel stupid. You feel like you made a mistake. Panic sets in. You start questioning the economy. It is an emotional roller coaster because gold does not produce cash flow to comfort you. Its only value is what someone else is willing to pay for it right now. When you own real estate, you do not check Zillow every day to see what your house is worth. You cannot. It does not matter. What matters is the rent check that hits your bank account on the first of the month. That cash flow provides a psychological cushion. It quiets the fear. You know the mortgage is covered. You know the asset is working. Real estate forces you to be a long-term thinker. You cannot day trade a house. The transaction costs are too high. This is actually a good thing. It prevents you from making stupid, emotional decisions based on short-term market swings. Real estate locks you into the game, and usually the long-term player wins. Gold, on the other hand, encourages speculation. It is easy to buy and sell. It tempts you to try and time the market, to buy low and sell high. And most people are terrible at timing the market. They buy when everyone is talking about it, the top, and sell when everyone is scared, the bottom. So, we have talked about leverage, cash flow, taxes, maintenance, and liquidity. We have painted a picture of two very different assets. If you have been following along, you are probably thinking, okay, Jack, gold sucks because it has no leverage or cash flow, but real estate sucks because it is a lot of work and you cannot sell it fast. So who actually wins? Here is the answer nobody likes to hear. The winner is the one that fits your strategy, but the smartest strategy is not an either-or. It is a hybrid. Let us look at a real math strategy for building wealth over a lifetime. This is the playbook I wish someone had handed to me when I started. Phase 1, the accumulation years. When you are young or in the early stages of building wealth, you have more time than money. You have energy. This is the time to be aggressive with real estate. Use the leverage. Buy that duplex. House hack. Live in one unit, rent out the other. Let someone else pay your mortgage. Yes, you will deal with broken toilets. Yes, you will lose sleep sometimes. But you are building an empire of equity. You are forcing your savings into a tangible asset that grows faster than inflation because of the leverage. During this phase, gold is just a distraction. It does not help you compound wealth fast enough. You want growth, you want leverage, you want tax breaks. Phase 2, the stabilization years. Let us say 10, 15 years go by. You have paid down some mortgages. Your properties have appreciated. You are getting older, and honestly, you are tired of fixing leaks. You do not want the hassle anymore. This is where we start to see the math change. Now, you might consider selling a property or two. But here is a better move. Refinance. Take out that equity tax-free. It is a loan, not income, and use that cash to buy gold. Wait, did I just say buy gold? Yes. Here is why. Now you have a chunk of money that is totally liquid, sitting outside the banking system, protected from lawsuits, depending on how you hold it and market crashes. It acts as your insurance policy. You still have the real estate generating cash flow, but now you have a moat of gold around your castle. If the real estate market crashes, you do not have to panic sell. You can sit on your gold, survive the storm, and maybe even use that liquidity to buy more real estate when prices are dirt cheap. Phase 3, the passive years. Eventually, you get to the point where you do not want to manage anything. You might sell all the properties, pay the taxes, and live off the cash, or you might hire a property management firm to run the show while you collect the checks. Your portfolio now consists of assets that pay you, real estate, and assets that protect your purchasing power, gold. See, gold is not a wealth generator. It is a wealth preserver. Real estate is the engine, but gold is the brake. You need both. You need the gas to get where you are going, but you need the brakes so you do not crash when the road gets bumpy. I know people who are 100% in gold. They are safe, but they are not rich. They're just not poor. They missed out on decades of compounding leverage. And I know people who are 100% in real estate. They are rich on paper, but they are stressed out of their minds, constantly one bad tenant away from a heart attack, with no liquid cash to save them in an emergency. The real math strategy is using the strengths of one to cover the weaknesses of the other. Let me tell you a quick story about two brothers, Mike and John. In the year 2000, they both inherited $50,000. Mike was the conservative one. He did not trust banks, did not trust the stock market, and thought the world was getting too volatile. He took his $50,000 and bought gold. He paid about $300 an ounce back then. He stashed it away. John, the risk taker, took his $50,000 and bought a rental property with a small down payment. Over the next 20 years, life happened. The 2008 crisis hit. The pandemic hit. Markets went up and down. Mike's gold went from $300 to $2,000. His $50,000 turned into roughly $333,000. He did well. He preserved his purchasing power. He did not have to lift a finger. John's house. Well, it fluctuated. It went down in 2008. It went up later. But during those 20 years, his tenants paid off his mortgage. Even if the house only doubled or tripled in value to, say, $300,000 or $400,000, John owned it free and clear. Plus, he collected 20 years of rent, which paid for the property itself and put extra money in his pocket. But here is the kicker. 5 years ago, John took out a home equity loan on his paid-off house. He pulled out $100,000 tax-free. He used that money to buy a diversified portfolio of gold and silver. Today, John has a house worth maybe $500,000 with a small loan, a pile of gold worth $150,000 because he bought it before the latest run-up and 20 years of landlord experience. Mike just has the gold. Mike is safe. John is free. There is a difference. So, gold versus real estate. Which wins? If you are looking for pure, unadulterated wealth acceleration and you are willing to work for it, real estate wins. The math of leverage and tax benefits is simply too powerful to ignore. It is the vehicle that gets you to the destination. If you are looking for protection, for sleep-at-night insurance, and for a hedge against the absolute worst-case scenarios, gold wins. It is the shelter you run to when the storm hits. But the truly wealthy? They do not choose. They understand that money is a game of resource management. You use real estate to build the pile, and you use gold to guard the pile. Do not get sucked into the tribalism of the internet. Do not listen to the guy screaming that houses are a scam, and do not listen to the guy saying gold is for doomsday preppers. Both of them are selling you something they want you to believe. Look at your own life. Look at your age, your income, your risk tolerance, and your stomach for headaches. If you are young and hungry, go find a house. If you are nearing retirement or you just want peace, go buy some coins. Or better yet, do what the math actually suggests. Build the foundation with bricks and line the roof with gold. It is not about picking a team. It is about building a system that works for you. Because at the end of the day, the asset that wins is the one that lets you live the life you want without constantly checking your bank account in fear. Whether that is a shiny bar in a vault or a rented duplex across town, the point is that you made a decision. You took control. And in a world where most people are just drifting along, that is the most valuable asset of all. I really hope this breakdown helped clear up some of the noise. It is easy to get lost in the weeds of this stuff, but when you strip away the emotions and look at the mechanics, the path becomes a little clearer. Wealth is not a mystery, it is just a process. And you are closer to mastering it than you think. Thanks for spending this time with me, and I will see you in the next one.